let's welcome my first guest, Arthur Hogan III. He's the Managing Director and Chief Market Strategist at National Holdings Corporation. Art previously served as Director of Research and Chief Market Strategist for B. Riley, incorporated in the Research Division. His financial industry career spans 30 years, during which he has concentrated on the U.S. equity markets, and Art frequently appears on CNBC, Fox Business, and Bloomberg TV. And we're happy to have him here today on the Income Generation. Art, thank you for joining us today.
Thanks so much for having me.
Art, just a few questions today. Well, we've got your expertise. You are an expert on the capital markets, of the highest caliber, actually. And so recently, corporate stock buybacks have been dominating the airwaves. We've heard about them from the Senate. There's socialism versus capitalism debates going on. What is all of this about?
Well, it's interesting. The debate over buybacks and whether they're good or bad has been going on for a decade, and we're hearing a lot more about it because there's legislation being introduced that perhaps there should be some regulation around that. And I think there's three things to think about, and there's some misgivings about what buybacks mean. Now, buybacks in and of themselves aren't necessarily a bad idea. If a company actually has excess profits and doesn't have another productive use for it inside its company with a good return on investment, they should return that capital to its investors. Those investors then take that capital and find better investments to make in other companies. So that's the simple economics. Where it becomes bad is two ways. First and foremost can be timing. Companies can do a very bad job of repurchasing their own shares, buying at peaks in a downtrending market, and actually waste a lot of capital, and that's probably the most common. The other is if there's any malfeasance in the use of this. Perhaps a company decides to buy back shares in front of its earnings, or to buy back shares in front of an options expiration for management compensation. Those are things that are the exception, not the norm. But I think in general, buybacks have increased and set a record last year for two main reasons. We had a new tax bill, so there was a lot of cash that was brought back in overseas, and the market capitalization of the overall market was much larger. So when you think about the buybacks in proportion to the market cap, they've been about the same for the last 10 years.
Yeah, that's a really good point, Art. We really appreciate that insight. But why are the Democrats attacking corporate stock buybacks? What's their point of argument at this stage of the economic cycle and the political cycle? Are they balancing politics for bad economics?
Yeah, I think that's the case. It sounds like a very noble case to make. These big bad corporations are making too much money. They should give more to us. And if in fact you skip the economic theory behind a buyback and just say, instead of giving money back to shareholders and having that reinvested in the economy, you gave that to your employees or you invested in your own company. So there is a certain attractiveness to that argument, but it fails to sort of join up with economic theory and financial theory. So that's the difficulty. It sounds great. Hey, these big rich companies should give back a lot of the money, whether it's to employees or investing for the future. But when you think about the best way to appropriate or redistribute capital, it should go over it should leave and exit into the best investment possibilities for the economy. That's where economic growth comes from, and I think that's where wage growth is going to come from.
You know, I agree with you, Art, and I think we'd see a massive amount of companies leaving the country if Washington decided to centralize what corporations should do with either their debt or their cash balance sheets and buying stock back for themselves, because there is a huge trickle-down effect in the expansion of that capital being utilized for stock buybacks. There's a big economic benefit. Okay, so let's shift gears here, Art. Tell me, if I go back to 2000 and 99, we saw corporate stock buybacks peak. In 2007, we saw them peak. In 2018, we also saw them peak. And so will we see another bear market divergence from these corporate stock buybacks, or will the stock buybacks carry the market forward?
Oh, it's interesting. Another myth around buybacks is that they carry the market forward. And if you look at empirical evidence, stock buybacks tend to increase earnings and market performance, between 1% and 2%. And if you look at the stock performance from 2009 to coming into today, we've certainly had an average of 15 or 16% on the annualized basis of stock returns. So it's not really driving the market. But I will tell you that the coincident measures to what happens at the peak of buybacks and then going into recession probably has a whole lot more to do with what's going on in the overall market capitalization. And I think when you think about all of those peaks that you talked about, there was different things going on in the economy that actually caused that recession. So there's no way to predict if we're going to have recession, and business cycles tend to last in different periods of time. This one happens to have lasted a long time. Along with it has come a larger market capitalization in the overall market, therefore a higher level of dollar-denominated buybacks. I don't think it's a signal of a recession. recession, I think there's a lot more signals of recessions that are out there that we should be looking at.
Well, I think as the economic cycle unwinds, what we'll see happen is corporations will start to tighten their financials a little bit. They won't be deploying as much, issuing as much debt to potentially purchase their own stock back. And so we do expect stock buybacks to start to decline. But there's no doubt that when we see corporate liabilities at this peak and all the other elements of the credit sector peak, we end up seeing some type of a pullback in the markets. And so how are you suggesting investors be agile or defensive at this stage of the cycle?
Well, that's a great question. I think that's probably the most important question. If you lived through this past December and were invested in the market and you saw the kind of volatility that we saw, or if you just look back at 2018 and realized that we had an unusually volatile year with 64 days of 1% moves in the S&P 500 compared to 50 on average and only 8 in the year 2017, you have to adjust three things. You have to think about your risk tolerance and what your plan is. And if your risk tolerance after last year feels like it should be lower, then you want to ratchet down your overall plan. Maybe not be as invested in equities, pare that back. I think the most defensive thing you can think about if you're concerned about a lot of the geopolitical things that are going on would be to raise cash. And what does that mean? So have part of your portfolio sitting in cash as an asset class. Cash as an asset class, when you think of what outperformed last year, that was the only thing that outperformed in 2018. So the third thing I think to think about is if you're a long-term investor, there's going to be ups and downs in this market. On average, we have 3-5% pullbacks and something north of 1-10% pullback in any given year. It's best to ride that out and not try to time the market. So the three things I would say, readjust, always look at your portfolio mix, raise cash if you're feeling uncertain right now, draw down some of your equity exposure, but try not to time the market.
Those are all great points, Art. Thank you very much. Stick around. We'll be back with more right after this break. Let's welcome back Art Hogan, the Managing Director, Chief Market Strategist at National Holdings Corporation. Thanks for sticking around, Art.
Thanks so much for having me again.
Hey, it's great to have you here today, Art. You're such a market capital expert. You've been in the stock market for so long. You understand the cycles and what's happening. We've been asking you some great questions. But right now, with corporate liabilities being at their all-time peak, how much further can we expand that $9 trillion? And what kind of impacts will that have on the market if corporate liability balance sheets are showing $9 trillion of debt when they were around $2.5 trillion back in 2008? I mean, that's quite a bit of the expansion. How concerned should we be about the size of the corporate debt going forward as individual investors?
Well, I think three ways to think about that. First and foremost, when you look at the size of the debt, you always have to compare that to how much equity is in that same framework, right? So when you think about debt to equity ratios, and does this look normal, or is it outside of the normal framework? Is it above average? And right now we're just about at average. We're not at the upper bound of average. So obviously debt levels are going to be higher with the higher equity levels. So think about where we were in 2008 with the S&P 500 at or about 700. Now it's about 2,700. Obviously, debt to equity ratios are going to balance off. So it's not alarming. What is alarming, though, I think, is that because we had low interest rates for that entire period of time, so virtually for the last 10 years with ultra low interest rates, the corporate America preferred way to raise capital was on the debt side versus the equity side. So that gets dangerous when and if we start to see interest rates going up. And it's not the total amount of debt, but it's the ability to service that debt in a rising interest rate environment. So, as Warren Buffett likes to say, when the tide goes out, you can find out who's been swimming naked. We're going to find out who actually, is investment grade rated and who probably should be junk bond rated, and that's probably where we have. But I think that portion of that overall debt is something that's very small. I think that in terms of debt to equity ratios, we're probably just about average, but dependent on how quickly interest rates go up and we start to find out who shouldn't have borrowed as much money in that ultra low interest rate environment, we'll find out pretty quickly.
Well, those are all great points, and I think you nailed it when you talked about servicing that debt. I think the next decade, I think starting in 2021, we've got half the corporate debt starting to mature 2021 through 23 and 24. Half of that is junk. We've got an enormous amount of federalized debt that starts to mature, and the projection is that the debt service federally will be the second largest line item on the budget. And so where do you see interest rates going? I see them going down to zero. They're not going to want to renew that debt at a higher rate because, like you said, they won't be able to service it. So tell us your thoughts.
Yeah, no, that's always been a concern, and we think about this all the time. Interestingly, though, in terms of separating those two issues, in terms of corporate debt and how much of that is sound versus federal debt, which is an entirely different issue, in separating those two, I will tell you, yes, we will get concerned, especially if, in fact, we start to see an economic slowdown. And surely somewhere between today and 2021, we're going to see that. That's when we're going to start to see either restructuring of a lot of the debt we're seeing on the corporate side of things. We're going to see a lot less debt issuance as interest rates go up. And I think that's where that becomes self-regulating. I think the amount of investment grade that lowers to junk is probably going to increase over the next 24 months. On the federal side, that's always been a conundrum. I don't think that we're going to have interest rates going back down to zero, but I don't think we're going to see them skyrocket either. A lot of that has to do with global centralized central bank intervention, and everybody seems to be at pause right now or at neutral. We just heard from the Bank of England. We've certainly heard from the ECB last week, the Bank of Japan, and our Fed all seem to be at the same place. And I think that is coincident with the fact that we're seeing global economic slowdown. That can change pretty quickly. And I think monetary policy and trade policy are in a battle right now. And if trade policy got out of the way, monetary policy would probably get back to normal. But where we stand right now, we should certainly pay close attention to. But I'd be more concerned about corporate debt than I would about our federal debt load.
Yeah, I think I'm right there with you too. I think that the stock market has maybe 6 to 12 more months before we start to see the debt impacted. I think the smart money will start to exit in 2020 as we see what the Fed does and what's going to happen with the budget going forward. So I'm in complete agreement with you on that kind of thing. So I think there's a few more months here we can maybe have a little more bullishness and capture some few more market gains. So that's where we are today. So Art, it's great having you here. Thank you for taking the time. Please stick around. We'll be back with more right after this break. Let's welcome back Art Hogan, the Managing Director, Chief Market Strategist at National Holdings Corporation. Art, thank you for sticking around.
You bet. Thanks so much for having me.
You know, Art, I'm a big fan of math as a tool for navigation to determine what you should have with your money going forward. In other words, efficiency testing and stress testing. What happens to money if we have risk, cost, withdrawal, growth as a combination. But going forward, if you're 60 years old, for our viewers here on the income generation, if you're 60 years old and you're getting ready to retire, you've retired, and you've got a portfolio of $1 million or $500,000, how much risk should you have today if you're trying to create income from that portfolio? Tell us what your thoughts are.
Yeah, that's a great question. We'd like to think about this in the rule of 4, right? So you want to have a 4% drawdown and be earning a 4% interest at the same time. So it leaves it in a sense leaves that portfolio unchanged. So what does that mean? You need to find a way to have a 4% return with the least amount of risk, and you want to not draw down more than 4% on a basis. We're living longer, so changing the way you decide about your long-term investment horizons has to be adjusted for that. So the fact that you're going to need to have this, if you're 60, you need to have this last for 20 years versus 20 years ago, you needed to have that last for 8 years. I think what you're looking at now is thinking about that asset allocation model that has the least amount of risk that gets you as close to a 4% annualized return. That generally means you either want to be in a fixed income product or something that is a high yield dividend product with very low expenses.
Well, Art, you must have been watching this show a lot because that's exactly what we discuss the majority of the time is fixed income and how to generate that yield and not be codependent on performance, but yet be dependent on income so you can subsidize your lifestyle when you retire. That's a really critical area. We like to focus in on that. What are some of the things that you would recommend for advisors or for clients to purchase for customers or purchase for themselves so they can generate that type of yield or income? Specifically, be specific. I mean, are there bonds out there? Are there preferreds? Are there good common stocks that are good dividend paying that are stable for fixed income like investments? What do you like?
Yeah, I think that the 3 ways to think about that, I think those are great questions. First and foremost, the biggest thing that is going to separate you from your money and that actual 4% return you need in retirement with a 4% drawdown is how much you pay in fees. So you really want to think about making sure whatever investment vehicle that is, it's got a low cost to get that type of yield. And I think that looking at that, there are there are dozens of things in the ETF world that are either mirroring the kind of yield that you get in a bond fund or mirroring what you would get in a high dividend equity fund. I think looking at things that way. The second thing that's imperative, and I think you brought that up, was dividend paying stable stocks. And unfortunately, dividend paying stable stocks have gotten very attractive in this low interest rate environment over the last 3 years. So that group can actually become very expensive. A lot of investors think I'm getting defensive and I'm going to buy things like consumer staples and telecoms, real estate investment trust, and utilities. Those are some of the dividend darlings that have performed very well, so much so that perhaps those multiples are a little high. So always look at what you're paying in terms of cost, because a lot of that yield can disappear if the multiple on those groups come down even 1 or 2 turns. So I think the third thing you want to think about is term. So right now in the current interest rate environment, and if you're looking in the fixed income world, I would still keep your term shorter. Meaning by I don't think you want to go out. I think you want to stay inside the 3 to 5 year time horizon versus going out 7 to 10 years. I think that's because the stability of interest rates right now are in question. I think that thinking about those 3 things, though, the most important of all those things is make sure your costs are as low as possible to get that 4% return.
Absolutely. So one question, Art, I've got for you. So we're really on the same page on a lot of this stuff. How do you feel about preferreds? Preferreds are bond-like instruments. They're not really traditional common stocks, but they are non-volatile components. So tell me how you feel about preferreds.
Yeah, we're very big fans. We do a lot of business in preferreds, or people like to refer to them as baby bonds. They have stability. They oftentimes pay in the sort of 5.5 to 7.5% return. They tend to be stable, but you need to know how stable the company is behind that. So make sure you know what you're buying when you get a preferred or a baby bond. If you trust the company, if you have the sound financial backdrop of that company in mind, if you like the sector that it's in, then issuance of baby bonds or preferreds is another way to capture that yield, and it's a very cost-efficient way to do that. You're in at one point in time, and then you're collecting that yield until it matures.
Absolutely, Art. I could not agree with you more. I want to thank you for joining us today. The Income Generation continues right after this break.